Good stuff. Let's get going. Time is now 10 CET, at least where I'm sitting. I'm sitting in Norway today. So on behalf of DSV, welcome to this particular Q1 market webinar, where we will speak into what has passed in Q1, of course, but also speaking into the future, especially when it comes to the topic that we have here, geopolitical tensions, trade restrictions, and how you can build resilience, adaptability, and flexibility into your supply chain, and how you can stay ahead of your respective competitors in your industry that you act within. A small thing here, we already now have a question in terms of recordings. This particular webinar will, amongst all the others, be available also for recording, so you can share that within your own organization. With me today, I have my usual suspects, CEO and co-founder of Zeneta, Patrick Berglund. Patrick, can you hear me?
Loud and clear, Morten. Good to be with you again today.
Very, very good. And my name is Morten, as you alluded to, Patrick. I will not be any guest speaker whatsoever, but I will be the facilitator of the webinar. Also with me today, I have a long list of true experts, true superstars within DSV. I have Frankie Boy leading up the road product when it comes to this webinar. I also have Christopher and Anders speaking into the sea freight product. I have Mari as well as Thomas speaking into the air freight product. And I also have Arcadio Martinez, who's our Senior Director for Global Tender Management, who will actually have a free role. Usually he has that, so he can speak into the different products whatsoever when he feels that there is something relevant here to add. Also, just a small thing, if you have any questions, we want a dynamic session. We will strive towards that within the speaking forum. But if you have any comments, any questions, you can already now pop them into the Q&A section, and we will take them as we go. But you can, and we also have time to actually covering that in the end of the session too. So pop it in if there's anything, right? So with no further ado, let's get going. The past couple of months has been, how can I put it, from a logistical point of view, they have been quite interesting, no doubt about that. The Trump administration they have enforced quite a lot of changes, and we will certainly touch upon that throughout the webinar, no doubt about it. We've seen trade restrictions or tariffs being enforced on many products in many industries, and obviously also on many countries. And we've also seen counter tariffs being enforced as well. We have ongoing ceasefire discussions when it comes to Ukraine between Trump, Putin, Zelensky. There's also been, for at least a modest period of time, a ceasefire in Middle East. Now that is somewhat gone. And to a certain extent, I think that this picture is speaking into what we're actually seeing in the market. We are breathing, we are going to work, we are alive, wheels are turning around when it comes to the businesses overall. But there is a certain feeling that the world is on fire. Despite that we are alive, changes are certainly appearing. The good thing is that there is also good stuff to report on too. So if we take, you could say, certain indexes related to air freight as well as sea freight, this particular graph here comes from Zeneta on sea freight. We see a relatively soft market. So trade and demand is, surplus, supply and demand is currently where, supply is higher than the actual demand, leading to that rates are low. That is good for you guys listening in today, of course, because you can then ship more for less. But there is also areas in particular where there is a risk, and we need to be aware about that, because that can put the market into a dynamic movement. Again, Trump is one thing enforcing restrictions, and then we also have ongoing conflicts. Now, I did speak into this on our previous webinar, that there are certain elements to factor in when we look at these particular risks. This particular world map was used, indicating, and I have my red mouse here, cursor, environmental facts, trade wars. We have, you could say, different ways of supplying or sourcing, going from offshoring to nearshoring, rising conflicts, also potentially between China and Taiwan, strikes, rising prices due to the inflation, that sort of stuff. And if we take it from a, you could say wheel of fortune, then you have these areas here. So when you swap the wheel around, you don't know where you will end up, but ending up on something positive is certainly less likable than what it was, let's say, 3 or 4 years ago. So it's certainly a different market pattern that we are looking into. So with that particular teaser, how do we then mitigate this? So Patrick, I will basically give you the word. If you can somewhat give a bit of your point of view on background here, but of course also how do our customers mitigate this? How do they create resilience, adaptability, and flexibility into their supply chain, making them able to be better than their competitors in their respective industry that they work in?
That's, I guess, probably the million-dollar question, isn't it? And
It is.
I think with that wheel of fortune that you showed, Morten, it shows also how difficult it is to plan for what's ahead, right? And I think you're touching upon the only option that any company have in this environment. It's to plan for flexible supply chains, whether that is multi-sourcing, nearshoring, having additional suppliers in your portfolio where you buy the goods or try to sell into new markets. This is all going to be crucial in order for businesses to adapt to the unknown that we're heading into. And if I take over the sharing of my screen, let me see. I just want to share a few things. Let me see if I got this right. So I think you bring forward the most important topics in terms of this geopolitical situation that we're in, and I don't want to go through all and each and every one of them, but because I think there's one that is above and beyond everything else, and that's currently the situation that we have in the US. Then it's the Red Sea situation. Those two are bigger and more prominent and has more impactful consequences than any of the other ones. You know, the situation in Taiwan can evolve and become challenging, but currently I would rank that further down the list relative to the situation in the US and the Red Sea. Now, if you look at the US, what do we know? There's a bunch of tariffs being introduced right, left, and center. Some of them paused, some of them implemented. But I think the overall approach from the US is that they want to have reciprocal tariffs, meaning they want tariffs set at the same level as US goods are tariffed when exported to a country, and they want to do this on a country-by-country basis. So the idea as per today is that on April 2nd, each country will receive a number that they believe represents their tariffs. So for some countries, this might be quite low, and for some countries, it could be quite high. And the US is not only looking at tariffs for US exports, but they're also looking at other measures that contribute to US trade deficit in goods, whether that is non-tariff and regulatory barriers such as taxes or even VAT, exchange rate manipulation, or any other practices that they feel is restricting fair competition. And you can see on the right-hand side here, the recent port fees proposed for Chinese ships, these port levies, right? And I'll get back to the actual impact of that. But if we take a step back from this sort of geopolitical landscape for a second and just look at where we are when it comes to the pure basics of supply and demand. In our industry, if we look at volumes going into the US West Coast here, illustrated through Long Beach and Los Angeles, it's very healthy volumes, right? And whether that is a front loading to avoid tariffs or the anticipated tariffs will hit, so they're trying to move volumes in as quick as they can. It's most likely, historically, we've seen that even in the first round of the Trump presidency, we saw this behavior. And what follows after this is a reduction in volume. And I want to flag that that reduction in volume would come in a market that has significant overcapacity already. And that's why we're seeing that downward pressure on rates that you showed one chart for. And I will show more on that. But if we look at that one specific topic of port levies, and we look at the portfolio of ships amongst the shipping lines, you will see that they're all exposed to this more or less. It's only Yangming that has an HMM that has some potential ability to avoid some of this cost, and it's significant cost because it's cumulative, meaning for every port they approach or enter, the fees comes on top. So if we look at the various services and which carrier or alliances are operating them, the TEU cost could range from about $200 per TEU to as much as $1,000 per TEU. And this will leave shippers and forwarders with even more complexity in terms of picking their ideal suppliers and vendors. And it will have significant financial consequences who they book and sail with if this goes all the way through. So this gives you an example. Now, back to that overcapacity situation. Look at the fleet growth. In black, you have the fleet in 2019. Then if you add this purple color on top, you can see the percentage increases in what type of vessels. So if we have a situation where the Red Sea reopens and demand is actually going down, and if you even have inflationary pressure so that consumption is going down at the same time, you might have a very, very negative market seen from a carrier point of view. But again, on the flip side, a significant opportunity for the shippers. Now, I think we're already seeing that play out. Can you see my web browser now?
Yeah, we can. Yeah.
So I just listed a few different trades here, right? Far East Main to North Europe Main, Far East Main to South America East Coast, Far East Main to US West Coast, and then 3 export trades out of Europe. What we're looking at here on the left-hand side is the movement of the short-term market since December 1st until today. As per today, you can see it's down 54.3%, down 62.4%, 36.3%, 26%. The only thing that has a little bit of upward movement for that period is North Europe to South America East Coast, and it's 4.5%. So it's insignificant. Overall, the picture here of the short-term market is significantly down, and you can see the long-term market has moved down with a little bit and significantly on the exports out of Europe. Look at the average 40-foot price here, going from 488 to 266 on average. This is not any sort of signals of a healthy market. Then I've put a few more columns: reliability, transit time, and transit time actual. And I just wanted to show you what the reliability sits on: 49.4%, 48, 56. This one, 71%, is arguably, the closest to anything I would describe as positive or sustainable. For supply chain people to plan with this, it's crazy difficult. And even worse so, if you look at the actual transit time that they announce, you can see, the schedule transit time that they put out, the carriers are not even hitting the numbers that they put out, but it's a meaningful gap, right? 46 days? No, it's delivered on average on 52 days. 38 days? No, it's actual 48 days if you ship from Far East to South America, East Coast, or into Europe. It's a miss of 7-8 days as well. So all of this paints a pretty gloomy picture in terms of the state of the market. From one side, pricing, which is so low. Secondly, the quality of the product that they're buying. If I zoom in, you will see very clearly here, Far East Main to North Europe, you'll see that downward pressure since summer, not only since December. So the numbers I gave was from this peak here, right? But it's way more significant if you look at it from last summer. And then here you can recently see short-term market falling below the contractual market, and that immediately will create downward pressure on long-term contracts again. So it's a pretty negative downward spiral. And then to double down on the quality of the product, the orange spread here is the announced spread of transit times. So the orange line is the average. And then the top line here, the greenish color, shows the actual. So they're outside of the spread of what they announce. And there's huge carrier differences here. If I just hit a carrier to see what is CMA, for instance, doing on this, you will see now in yellow CMA, they are at least within the spread, right? But it shows how difficult it is for your customers and you as a provider to now pick and choose the right suppliers for the customers. Regardless of what you choose, I would argue you bring a weak product because none of the carriers are really doing phenomenally well, but you deliver at least at a cheap rate at the moment versus what we're coming from. So my overall message, I think, is there's very little that I see on the horizon that is going to be that is positive for the carriers besides port levies. If that is introduced, they will pass the cost on to the shippers, right? Yeah. And then secondly, if you think about this from a shipper point of view, whether you should assess all possible origin destination that you can source your cargo from, and you should think about how long you contract in this current market, because it's moving so fast that even if you contract on a long-term basis, you might lose out significantly if the market continues in this direction. And we've seen that before. Two things. We've seen it in Q4 23 when it goes down to sort of loss-making territory for the carriers. But then we also saw a few weeks later that it can turn around so quickly. So being flexible both on how you buy and where you source cargo from is probably the two biggest things that we can flag and mention as approaches to navigating these difficult waters.
Thank you, Patrick. I just want to allow Arcadio to speak into this. Arcadio, do you have any nuances that you want to add into the equation here?
Yeah, I think that on the greatest slides from said by Patrick, right? One of the things is that when we're talking about the US tariffs, right, and then the carriers to be affected, it's not only the carriers, we also need to think the alliance they are members. Yes. So in that case, obviously Yanmin looks good, but they are part of this premium alliance, which also comes ONE, which is they want to have a lot of capacity there. They also have independent capacity, but I think in overall, this new kind of legislation is kind of like reaching all the carriers that we have in the sphere. So obviously, if it comes into play, there would be so many ripple effects that would happen, and not only if the carriers being affected, but also maybe how they're calling the ports and how the services are being done. So that, as Patrick said, it would have a huge impact into the shipping industry. And then I think I also had a small comment on there as well, that even the lane of North Europe into South America is continent, right? Is the most reliable one with 71%. We shouldn't forget the congestion level we had at Brazil. Down there, I think that last year we reached around 3 weeks waiting time by the vessel. So the vessel might be on time, but it will take quite a time to actually download the cargo, right? So that is also a little bit of some of the nuances that we need to find as well when we get into these things, right? So, but overall,
yeah, so what you're saying is that the KPI might look right, but the perception, when it comes to the actual product is worse seen from a customer or freight buying point of view. I just have and Arcadio and Patrick, please, because we need to add some value for the listeners, right? How can they use this information to their benefit in their respective countries? So companies, Patrick. So what you're saying is that we consider the market when it comes to rates being low. Agree?
Yep.
Yeah. Arcadio, my question to you then is, do you foresee more dynamics for the next couple of years within the sea freight market? Up and down, great spikes?
Yeah, I think that at the moment there's a lot of supply in the market. And one of the things I've seen is that there's so much overcapacity. And if the Red Sea, for example, would open at any time, right, it would have a huge impact overall in the mid-long term to the industry. So yes, we will have these up and downs, but I think that at some point, I think that maybe carriers will, or maybe I would say is that I foresee in some time a low market that actually kind of maybe cleans the situation of the overcapacity.
Yeah.
Carriers are talking about old vessels that they would scrap. Basically my experience tells me that they only scrap vessels when they lose money. So then we will need to wait for a very low market for a while that actually they start to move and actually clean up the capacity.
And you're leading me to the main question here for the audience, and that is, and you can both chime in on this. Is this the time for customers to lock in? I wouldn't say all of their, you could say freight rates, but at least a part of it into a long-term rate. Would that be a good suggestion, seen from what you see into the market?
I'm happy to give a quick comment to that before Arcadio chimes in. But from my point of view, we see an unprecedented appetite for index linking contracts, because if you think about it, this constant back and forth negotiating a price point makes absolutely no sense. Even if you lock in a 12-month price and something happens in the market that deem it irrelevant, up or down, right? You've wasted an enormous amount of time and efforts and resources into agreeing a price point that is invalid. And now over these, past 5 years, the buyers and sellers have felt the pain of this dynamic so many times around that they're looking for alternatives, right? A way to stick with your suppliers, build a meaningful partnership, but then have a mechanism that adjusts prices relative to what is happening in the market, because you cannot, everyone's in the market, whether it's, up with 300% or down with 70%, this needs to be dealt with in a more seamless, smarter way than what historically has been I would say, carpet pulling, right? So in principle, yes, it is a good time to think about allocating some of your volume on a longer term contract. I'm not opposed to that at all, but I would definitely urge everyone to look at mechanics that would adjust that price point if there's sudden market movements up or down, in order to take some of the tension away from the partnerships.
Good. Thank you, Patrick. And we have a question here. What is considered a long-term rate? I would say anything between 6 to 12 months. I would anticipate that being a long-term rate. Arcadio, over to you.
Yes, just to maybe add that I think I would maybe not think on pricing, I will think on service. I think with all this volatility, you don't want to lock whatever shipping line or service, because at the moment I will see a lot of changes. There is a lot of overcapacity, so I think that the carriers will need to start removing services. We also see carriers offering hub and spoke solutions, direct solutions, and I think that we need to try how they're working. We don't have actually, right now, reliability is very low. I think it will improve, but I think also what I mentioned before, one thing is what is on the paper, another thing is what is on reality. So I think that from a flexibility point of view, you need to look at the best option for the different trades. And unless you have a very good predictability saying, okay, this is maybe just Shanghai into LA, is a very easy kind of route to do it, I will not lock mid-long-term rates for that.
Okay. Thank you, Arcadio. I will give the word now to our other two guest speakers. That is Anders Olsson and Christopher Hedin, who will also speak into the sea freight market. But Patrick and Arcadio, please chime in if there's something that you do not agree with or agree with, but you want to elaborate even further on.
100%, yes.
Great. Good morning, everyone. Nice to be back on this webinar. And since we have limited time, we will jump straight into how it looks on the 7 seas and our ever-evolving, lovely container shipping market. And Patrick, Arcadio, and also Morten has mentioned disruption all over the place. And let's jump in and have a look on the world map. And in front of us, we can see the circles, and that's the number of vessels being tied up in congestion. And then you have the number of days in different ports around the world. And what does week 11 tell us? It tells us that 9.2% of the vessels globally is tied up in congestion. And folks, that is not great. We have to go back to January 2023 to see this huge congestion in the market. And just FYI, during 2024, when I do the calculations, we had an average congestion 6.8% full year. And the highest levels, as you all know, was during COVID. It was 2-digit numbers during 2022. And there's many reasons, as some of us has touched based on already, behind this congestion. And of course, the first one is the Red Sea. It is not optimal that we are not using the Suez Canal within our industry, of course. And another thing we have seen, it's the strikes. We can go back to October 2024, US East Coast and the Gulf, the 3-day strike there, and then it was moved to the mid of January. This is not good. It is a disruption. Even if it's not a strike, it hits our market. And then also, since it is a North European webinar, I will mention some countries in the Northern Europe. We have seen smaller strikes in the Netherlands, Belgium, Germany, France, and in this market, we need calm water to get back to a better schedule reliability. So that's not optimal. And another thing that you all know, a big thing happened the 1st of February when we went from 3 alliances to 4 alliances. And when you do that, you need to do a lot of reshuffling of the vessels. And it takes time to get all the vessels in their new loops and services. So another thing I need to mention that I just came to my mind is right now we see quite a lot of volumes moving in to the Northwest continent, and that's the Chinese New Year's volumes, and that's not optimal in the market we see right now. So this cocktail, I like bars, so this cocktail, it forces now shipping lines and feeder operators to change their schedule a bit. And in some cases, if we look at the transshipment hubs here in the northern part of Europe, they changed the transshipment port. And of course, as Patrick mentioned and Arcadio, if you shift the slide, Morten, the schedule reliability is really poor. And the numbers I have right now is the January numbers. And if we have a look on the global schedule reliability in January, the average plus minus 24 hours, main port, 51.1%. And that means that half of all the vessels globally are delayed. That's really poor. And if it's a delay, the average is around 5 days. And if we have a look on the top pink dot over there, it says 50%. And what we want a market that is around 80% globally. That's a good and stable market. And as you can see, as Patrick also mentioned, it's a long way to go, really long way. So folks, we're in for a ride, so to speak. And
I have a question coming in here. There's actually quite a lot of questions coming in. Just on the short sea market, a trade such as Estonia to the UK, so importing into UK. Do we see the falling rates? Do we see a soft market when it comes to the short sea? Maybe you, Arcadio, you would have some insights on that.
On that specific trade, I'm sorry, I don't have the visibility.
I put you on the spot here.
Yeah, but I definitely, on the congestion that we have at the moment, I think that is more difficult to move the cargo through these ports at the moment. Yeah. So, yeah.
Okay. Good stuff. I will move on.
Yeah, me and Anders, we had the sit down before the webinar, and we said, okay, how should we describe this market in one word? We failed. We were able to come up with 3 words to describe this market, and at least all the 3 words starts with and Anders, the 3 words, you can see them in front of us. And why did we choose these 3 words?
Yes, indeed. I think the first one, uncertain, speaks a little bit for itself, right? There is not a single person in logistics who has a plan anymore. I think most of us are down to plan 12D in trying to deal with the multiple uncertainties across the globe. The unknown speaks to the fact that we are in a position right now where barely a week comes without something new being added to an already long list of challenges that we need to deal with. And then we have unthinkable. I wanted to go with unfathomable, but was told it was a bit pretentious. So instead we stuck with unthinkable, which in this context means basically that a lot of the stuff currently going on would have been hard for us to imagine just 6 to 12 weeks ago, right? We've decided to brand this as the U3. Basically, as you can see, we've also trademarked it in case anyone from the competition is calling into this sneakily, so you don't get any ideas here, right? But I've never much been a fan of the band U2. I think the bass player, the Edge, has a sort of ridiculous hat. But the more I think about these 3 U's and the causes driving them, the less I think I like them even less potentially than I do the band. But we have a problem here, right? And despite everything going on and the impact that it's having for everyone in logistics right now, we are genuinely concerned that things might be about to get worse rather than better. And how could that even be possible? Well, next slide, please. Of course, it's this guy, right? Here pictured with a nautical hat to give him that sort of Gantt catalog vibe that we've all come and love and like in Europe and North America over the past few years. This merchant of chaos and the administration that comes along with him have taken a lot of actions of late, and both Morten, Patrick, and Arkadio have spoken to some of them already. If we start off from the top, and Christopher already mentioned it for good reason, because it's the most driving, impactful thing happening in the world of shipping right now, it's the Suez Canal disruptions. We thought we were off to a good start here with a ceasefire going along with and extending into Yemen and Iranian territories outside of Gaza and Lebanon as well. Unfortunately, it's taken a tumble, right? With the peace process taking many steps backwards over the last few weeks, the US really ramping up the bombing of both Houthi attack sites and leadership. And right now it feels more uncertain than ever when normal shipping patterns can potentially resume. And by normal, I mean, of course, transiting through the canal. Yeah,
Anders, we actually have a question associated with that. Do you think that Trump will try to impose tax on Suez Canal usage to compensate for the US attacks on Houthis? What would be your...
I mean, legally, it's not possible, but that's never stopped him before, right? I mean, the Suez Canal is operated by the Egyptians. So a US tax implementation on Egyptian soil or water would, of course, be tricky, very, very tricky legally. Could he then, on the other hand, impose fees on those that transit the canal and also call the US or some similar shenanigans? I mean, it's 65 and pick him as usual what he's going to decide to do, right? Mm-hmm. But right now, I haven't heard any credible signs pointing in that direction. Sort of.
Got it. Thank you.
Yeah, going back to the tariff and trade war, and we won't deep dive into it, but the thing I want to highlight here is that tariffs impact trade patterns. The result of how ocean shipping, particularly liner or box or container ocean shipping, is structured right now across the world is where does the cargo flow? And with trade and tariff impositions and changes, right, or implementations and changes, comes potentially changes of global trade patterns. We've already right now sort of wrapped up, even though we're really midstream, a global reshuffle of the alliance structure and the loops that they operate their ships in across the world. If we need to do that again soon, because suddenly trade starts to dry up between China and Europe, other parts of Asia and the US, or US to Europe, that's going to have a big impact again on the schedule reliability and congestion of the world. And then, as alluded to by Patrick as well, we have the so-called Make America Great for American ships. And this man is nothing if not consistent in his branding, although not so much in different areas, right? But essentially what we need to be aware of here is that should these changes, and they're not yet implemented, as Patrick alluded to, they're currently in the public comment phase, as it's called, where you take in advice from industry and others. Should they be implemented, this will also have a significant effect, not just for cargo to and from the US, because these carriers will try to be smart in not just their order books into the future to avoid those sanctions and fees, but also in potentially utilizing reflagging or some of the US-built vessels currently operating on other trades into the loops that they have today. So we are right now in a really tricky situation, to put it mildly, right? And a situation which might be still deteriorating. So with everything that's going on for everyone in logistics, this sort of begs a question, right? And next slide, please. What should I be doing? I joined DSV about 2 months ago, and my last job prior to this was as head of logistics procurement for a fairly large and fairly media famous Swedish battery manufacturing company. So what I'm trying to say there is, coming from logistics procurement very recently and having joined in COVID, during COVID and exited in December of last year, I know what you're going through. I know the pain, I know the stress, I know the feeling of not having control of the day-to-day operations. And unfortunately, and my colleagues in the call have alluded to it, it's really uncertain right now how to try and impact in a hand-fast way how your shipments arrive on time or not, due to the fact that most hubs are clogged, most shipping lines and alliances are impacted, slightly different in slightly different ways. But there are no single pieces of advice to give on if you ship Zimline via Rotterdam, you're good. There's nothing akin to that. That's sort of a viable option, right? So if I would focus instead on some pieces of actions that are actually tangible and doable, and which I found made my life a lot easier, although still certainly chaotic over the last few years. The first one is to stay informed. Right now, you can just watch CNN or the BBC or read The Economist or whatever daily news source you have, right? But shipping will once again creep into the shadows where we sort of enjoy life normally. And when that happens, make sure that you have channels for shipping news that you trust and stay updated through them. The second pillar is making sure that you communicate, contextualize, and teach within your own organization. Once you're up to speed, make sure that all the way up to senior management and potentially the boardroom, the same goes for every stakeholder that you have internally in your company. I call it Eli 5, or explain like I'm 5. By that, I don't mean talking down to anyone. What I mean is talk to people outside of logistics in terms that they are familiar with. Give them the full context and don't dumb it down, but maybe shy away from some of the many abbreviations we know and love. And make sure that everyone understands that this is not a short-term problem. Most credible people in the industry believe that we will be in a rocky future for yet another fair few months and potentially years as well. And third, to wrap it up here, we are here to help, right? DSV will resume sharing our extensive market information that we usually make available as soon as we can. Right now, we're in the midst of a major acquisition and integration that we're about to embark upon, which means we need to be even more careful than usual about spreading signals into the market about where we believe things are, but that will be resumed as soon as we can. In the meantime, please feel free and even encouraged to reach out to your local DSV sales contact, operational contact, product contact for any information you require. And also, as a final offer here, we would be very happy to assist in briefing your company leadership. Get in touch with us. Let's set something up where we can explain and contextualize what's going on.
Yes,
That's
yes,
it for the Shuttle brothers here, right?
We have our amazing market reports from Arcadio, and we will continue with our quarterly webinars. So good stuff. We have a tight schedule. I just want to give the word, just finalize the sea freight section. Arcadio, as well as Patrick, any concluding words from your side, given the speaks from Christopher and Anders?
You want to go first, Arcadio?
Yeah, so I think that we just need to be flexible, right? You need to be flexible, and what we said, right, is I think it's good to maybe look at the market, take advantage of the rate reductions. And I think that for example, on the carrier reliability, right, what you are seeing right now is still the all alliances. It's vessels that are arriving now. So when we talk about 50%, some of the carriers have promised 80%. It seems that they might achieve it, but again, the evil is on the details, right? So they will probably measure on a main port to main port, but at the end of the day, what really counts is your container arriving on time to your port. And that's actually, with the congestion problem, I don't think that they will achieve this 80%. But saying that, it seems that they will improve going forward. Yeah.
I think my final comment would be that I expect a longer term challenging market as long as the US policies are so unpredictable. So for me, I don't think we're talking about, month or year period. I think we're talking about a 4-year period that's going to be challenging for the industry.
Thank you, guys. Thank you very much. All right, onwards to another important product. We have Thomas and Mari. Mari is actually in Copenhagen doing another guest speak, so we are sort of disrupting her own schedule here. So I don't know who's going to start, but I'll just pass on the words to you guys.
Yeah, we're not doing ladies first right now. We're actually doing gentlemen's first. So I'll pass the word over to Thomas.
And thank you for that, Mari. My name is Thomas Elmelund, and Mari and I will try to give you a short insight to the air freight market over the next few minutes. And if we start on the demand side, then we just came out of 24, which was a tremendous strong market. We came with double-digit growth rates compared to 23, and was actually expecting these to continue into 25, but I'll show a little more on that on the next slide. Then when you look into the capacity side of it, then we have a fairly good idea of what capacity is going to be deployed in 25. And the general guesstimate is we are going to see an increase in capacity of approximately 3%. And why not a larger capacity increase? The reason is actually that Boeing and Airbus is both delayed on the deliveries on the flights that they have in the order books already. So despite we are in a strong air freight market, the capacity in 25 is still going to be limited to about those 3%. And then we do have the e-commerce, and the e-commerce is still the big joker in our industry. Will the likes of Timor and Shen, will they continue the crazy growth rate they had over the last few years in 25, or will the de minimis legislation put a hold on the demand? And I know Mari will give a little more insight on this in a few minutes. If you look at the market fluctuation, this is very different if you look at it on a geographical scale. If you look at the inbound Asian traffics, then they're always in high demand. The same for the cargo, the carrier capacity. And actually, if you look to Europe, the outbound Europe towards Americas, especially in the winter season, is always in high demand. And normally when you get into Q1, you see US demand is decreasing and rates is declining, and you will see it even further once you get into the summer schedule, April 1st. But we've actually seen this year around that rates are still keeping a certain momentum for the US. And the reason for that, of course, is that a lot of European exporters and a lot of export in the Nordic region have front-loaded into the US and built the stocks. They also have been using air freight for that. So they're trying to get ahead of the US taxation. We're actually still seeing a certain push for air freight capacity into the US because a lot of people are still spending more air freight than they normally do. And the reason for that is time to market is short. And where the ocean freight, they're primarily offering U3 with bad notes. The air freight at least is offering some certainty into the supply chains on an order base because you can simply get onto the market easily. And with Trump being in and tariff being imposed with short notice, I think that certainty is important for some. And the airlines is very much monitoring these trends and patterns, trying to optimize the yield and the capacity to the highest extent possible. So they are very much looking into where are the yield and high demand, and they will, and I do believe we should expect, elevated rates for at least the constrained routes and the constrained periods. But on the other hand, we will also have plenty of routes outbound Europe to Asia, outbound US to name a few, where there's more capacity than there's demand. So it's going to be a different balance if you look into the geographical regions. And finally, if you look into the sustainability agenda, then we implemented the Refuel EU on April 1st, a new initiative on a SAF portion in the blend. And we will see the same from a lot of Asian countries and Australia during 26 and 27. So cost of this SAF fuel will add to the air freight, but on the other hand, on the more positive side, this is very much needed to reduce the emissions from our industry. So it is going to continue over the next couple of years, this SAF implementation. And if you just join to the next one, then as mentioned, we saw at 24 in the latest green of it, where we months on months had double-digit numbers. So basically, we came out of 24 with an increase of 10%. And expected to come into 25 in the same pattern, meaning that we would have a much stronger demand than we would have capacity influx. But we've actually seen here in January and February, the first 2 months of 25, that the combined growth is actually only 2%. And the good question, of course, is this directly related to Trump and the tariffs? Is this a consequence of this? Or is this just a picture of the first 2 months of 2025? But it's going to be interesting to see if this is a continuous pattern during 25, because then we are more balanced between the 3% capacity increase and the demand increase. But we'll have to see how that plays out. That's certainly something that we're going to monitor very closely.
I think this picture paints a great perspective, right? It's very cyclical, and we certainly see it here, right? So I would, just from the visual graph, somewhat state that we are looking into a market going slightly red here, right?
If you're looking into cycles, like I would agree with you, Morten. But the 24 numbers is very, very much impacted by the growth of the likes of Timor and Shen.
Yeah,
so that growth is primarily driven by the e-commerce. So actually, if you look at the general air freight, it's more flatlined. So it's actually the e-commerce driving the growth in 24, why we actually expected it to continue into 25. But it all depends on the growth in e-commerce and, of course, also how it pans out with these tariffs that might impose. But you could be right. It could be downclining the demand, but we will have to wait and see for the coming period. Yeah. And the last slide I have before I pass it on to you, Mary, is just, we talked about the capacity coming in. And if we look at 24, then we can actually see that the majority of the capacity coming into the market was actually not related to new passenger flights or related to new freighters. It was actually more retired passenger flight being converted into freighters. And the reason for that is simply that we know Airbus is delayed on the 350 deliveries, and we know the same goes for Boeing's 777 flights, that these are also delayed into the market. So we would only expect a limited number of those to come in 25 and probably also in 26. So again, our expectation in terms of growth in the capacity is relatively limited in 25 and probably the same in 26. And Maya, perhaps you can walk us through the next couple of slides.
Yeah, I will. But first I have to say that, Anders, we need to have a conversation later about U2, because it's important for me that you like U2 going forward.
Well, I'm happy to receive a mixtape, Mari.
It's good. It's good. Just wanted to remind people also in terms of what the de minimis actually is. The current legislation, or might be the previous one, we're waiting for the new one, but it's temporarily on hold. But the one that's working right now is the $800 threshold, basically. So everything shipped from a non-US location has no import fees. Which is a gold mine for the e-commerce, and obviously my favorite word, Temu. And also what's then possibly going to create this large disruption is the new de minimis rule, where a shipment who contains then one or more goods made in China, Mexico, or Canada will not be under the same threshold. Those orders will be value or subject to import fees that then requires a customs entry. Changes everything when that's implemented. Other cargo is then, but that's not made in China, Mexico, or Canada, coming from a non-US location will still go under the old rule. But again, when this is implemented, it will be a game changer. When or if. If you see here, then the impact in terms of tonnage for the e-commerce, well, it could be substantial. You're seeing a number here that says 1.3. And then you also have the other part of what's going on in the US, been mentioned several times now, the tariffs. If you look back in time and saw what happened the last time, it had a 15% impact, which is then 0.4 million tons per year. This is huge. And then if you look at the next slide, this could then possibly mean 60 freighters currently serving the e-commerce market, finding new markets. It's a lot of capacity. Might solve the problem that you mentioned, Thomas. But it's interesting, and we don't know. And going back to also the U3, well, you trademarked it, but I think I'm going to use it as well, Anders. This is linked to that as well. It's a bit uncertain. It's a bit unclear. So, but it will have an impact when we look at it. And then if you further go to the next slide and look at the other disruptors, yeah, we might be coming down in terms of weights and everything, but we need to stay resilient. And we need to breathe while also act on the correct facts.
But Maya and Thomas, and coming to that again, paying a purpose for the audience listening in. What should they entertain when it comes to their, you could say, own agenda, making that resilient supply chain in their companies?
I would say correct facts right now, not acting too fast when you don't know all the details, but still acting fast when you know them. Thomas, I'm not sure if you agree.
Yeah, I do, because to be frank, it can go in both directions. You can either see quite a decline in the demand, or you can see the opposite, actually. If the Dominion is not put on hold, which it is right now, then we can easily see a strong market as well. So I would actually play it out a bit before I really lock my volumes in, because at least for the long term, it could go both ways, actually.
It could, and in terms of the de minimis, they need to get their digital systems in place as well. That's also why it's put on hold right now. So that's also a big impact. If they're going to implement that, they need to have systems in place to actually handle it. So yeah. So it's interesting, and if you look at the market also in terms of different situations that's currently going on, we saw last weekend in London with the fire, also huge impact. But again, everyone's also quite able to act quite fast in terms of the derouting and everything, and also the carrier response to it.
Yeah. Good stuff. You said to be frank, and we actually have Frank representing road freight. So,
one thing, if it's possible, I would like to add a note into the e-commerce, right? Because it also shows you a bit the level of improvisation of the U.S. government, right? They put the de minimis, they actually forbid them from one day to the other, and then they actually found 1 million shipments in JFK that they were not able to handle.
Yeah.
So the customer administration said, sorry. So on that Friday, that was when they kind of posed this regulation. They were talking about April, and the last update that we got last week was that now they're talking about September this year. So right now we have this pause on the de minimis until September that they can still fly into the US. And obviously this creates a big hole now in the US customs, because if somebody ships via ocean, they might pay 75% tariffs on those goods. And if you air freight through e-commerce channel, then you will pay 0. So in that sense, it already shows you what the administration is trying to achieve and is actually getting at the moment. So that's a lot of improvisation compared to also maybe the European Union, that they also want to attack the e-commerce, but that legislation goes a bit slower and there's a more discussion phase, right? So we know that those things might change, but it will basically, we can be informed, right?
And it's going to be interesting to see how EU unfolds their sort of retaliation to it. So yeah.
Very good. Thank you very much, Arcadio, for chiming in, and especially thank you to you, Mai, and Thomas and Mai. Good luck on your guest speak in Copenhagen.
Thank you.
Again, we move back to the good old Frankie boy, speaking into also another very important product, our road freight.
Thank you, Morten. Can you hear me, Morten?
Yes, we can.
Okay, excellent. Yeah, you can tip the slide. That will be fine. Yeah. So thank you once again, Morten, for the invite. I just want to maybe take us a little bit back to our last webinar, where we forecasted maybe a little bit more positive trend for the Q1 and Q2 of the road freight in Europe, northern part of Europe. This has simply just not been the case. We see volumes are down. We see that trades are not happening in the same tempo or the fastness as we have expected. So we are still waiting for this bubble to burst a little bit on the road freight in Europe, so to say. This in combination with a still overcapacity in the market, together with that this slowdown in the economy, and if the slowdown in the economy is the entire reason for this lack of shipments, we cannot entirely say if that's true or not, but it's for sure a reason, one of the reasons for that. So we expect that this overcapacity, for example, that would not stabilize for at least going into Q2 of this year. Morten, looking into different industries, I like to bring up one industry which I think is on the tongue of a lot of people these days and has been it for quite some time. That is the defense industry. And my dear colleagues here, they have, several of their presentation here has been mentioned war and Ukraine and Trump and all this. And that's one thing for sure for the defense industry in Europe. We see that all the countries are ramping up their defense budgets, their investments on personal side and also the technology side, and this leads to an increase of the manufacturing in all sorts of products within this industry.
Yeah, and I think Frank, I have a comment on this, and Arcadio, please chime in too, right? Because there's been in the media this kill button coverage. Would the Americans be able to kill off, you could say, the operations of the F-35s that are quite represented across the European continent, leading to that several state actors have been out saying, okay, we should supply our defense sector from European manufacturers, and if that would be the case, right? That would certainly also put even further stress upon, you could say, capacity in Europe. But Arcadio, maybe you want to chime in on that as well?
Yeah, I think that obviously we see a change on trend, that one, right? Because on this button that you also mentioned, they said that all this new equipment needs to have a lot of software updates. So in a sense, they could do that. And I think there's a lot of fear at the moment for a lot of European states, and they are really looking at rebuilding all this industry within every country.
Mhm.
So that would actually create a change in the future.
Sure. Thank you. Back to you, Frank.
At least just to finish up the industry, the defense industry, what we see is that we see a lot of these major European companies also in the Nordics. They are all reporting on a huge backlog on orders to be manufactured on a short-term and on a long-term basis. And this will have an effect on other industries as well, because for the less pure defense industries, they will have to also ramp up their supplies to this industry directly. So this is something that we are going to monitor really closely in the future, and it's going to be really interesting to see how it's going to develop. Historically wise, when the defense industry increased their business in Europe, at least, then it has been good times in some parts of other industries as well, and that leads to increased freight as well. So earlier in the presentation here today, there was a question related to, I think it was a short sea from Estonia to UK, and UK is another market that we unfortunately monitor really closely, and we see huge changes in at the moment, and this we expect further through the whole year of 25. The market will be down. We don't see them coming back on the export sides. We put in different initiatives to get back to where we are or earlier stages on both import and export to UK. This is something that is really important for us. But one thing I want to just bring on, I see time are flying, Morten. So one thing I would just want to bring on again, which we have been talking about for the latest, I don't know how many webinars, that is the single one most and biggest challenge in Europe, that is the truck driver shortage, that is at a crisis level, and that is just seems not to stop. There are different numbers in the market, and we are very cautious to say too high numbers, but it is at least at 750,000 vacancies, and this is one thing that is really we're going to struggle with in the future. So we hope that will in some. The negative trend there will change in somewhat, and then again in connection with the defense industry, there is a high demand of drivers with origin from a NATO country, and this is lacking heavily in the market at the moment. So this is something, at least by DSV, that we are working on to secure.
I did hear a rumor on that DSV has taking over DB Schenker, but still not integrated. But I know that there is rumors are saying that they have a lot of drivers. So hopefully we can
of course
provide a better network in the future as well.
but they are also bringing in a lot of cargo and a lot of business already that you need to manufacture, need to do production for. I just bring up my last slide. And this is also a copy in from the last webinar. Just remind you the listeners and the market that road tax, new road taxes in Europe, we tend to get a lot of questions related to this, how it's calculated, how it works, and the effect, and so on. The ETS is increased, and this is something that all should be aware of. So just feel free to send us questions, either to me directly or through Morten or whoever. If there's any questions related to this, we happily answer on this. But be aware.
We do have a question, Frank. This is not related to the road tax, but more on driver shortage. What's the ideal solution looking like, and to plug the gap or bridge the gap, if you could put it like that? Salary increases, or what is the root of the problem, and how do we solve that?
Yeah, well, there was one huge initiative which is still running. Basically, that was the EU mobility package, and that's still running in some sense. But it is that you need to increase your salaries for the drivers. You need to give them better working condition. You need to make it more attractive for the truck drivers to work in this business. This is a tough thing to work on, unfortunately. So it's really a difficult thing to answer on. Really more.
But of course, bringing up the salaries, maybe doing some automotive cars driving themselves, right? That sort of stuff could lead to the bigger question of a resolution that would work, right?
But just to finish it off, I always, when I get some of these type of questions, I say, but listen, guys, I mean, there's a reason why we are in this situation. I have a son of 19 now. He's in the military service and he's happy for that. But I'm not telling him to be a truck driver when he returns. So this is, I think it goes for maybe 95% of the at least for the northern part of Europe, people saying it's not on your top list choice of work, right? So unless that you have a family relation working or you have a family owning a huge haulage business or whatever, then it simply not is. So yeah,
I would agree to it.
Yeah. All right.
Thank you very much, Frank.
No problem.
And if we are lacking drivers, we will put you in one of the trucks as well. But please stay on. Please stay on for the remainder of the minutes. Okay. We also have a question here. Getting the validity on rates for long-term rates export China to Europe. That has, for the last couple of years, that has been very, very difficult, and more spot rates have been the only possibility. And I agree with that. That can be an issue overall. Now the market is a bit more soft. The carriers are a bit more hungry. So I will allow myself to answer. So if now is the time. So if you want long-term rates, I would definitely push for it for the time being. But obviously, you also have to come with a certain threshold when it comes to amount of containers that you need to ship as a client. It won't make any or break any deal if you come in with, let's say, 100 TEUs. That would be too little for the carriers to entertain, unfortunately. Anders, a question here for you. You alluded to shipping news. What would you recommend, other than, of course, going into the website of Xeneta, staying on live with these webinars or our market reports? But do you have any specifics that you want to chime in on?
Yeah, for sure. I mean, I think it's a lot about finding what you like yourself. But if I'm supposed to give it like a quick 3 that you can't go wrong with, I would say Lars Jensen, the famous, and God bless him, expert who publishes daily updates on LinkedIn, particularly about the Suez Canal and Red Sea, but other stuff as well. I would follow Lars, and I would consider reading Tradewinds and Shipping Watch as well. Then you can delve deeper into G-Captain, Maritime Executive, and despite the ridiculous name Splash 247, it can be a pretty good news source as well. But the top 3 and then the following 3 for some additional depth, and you're off to the races, I would say.
Very good. Thank you for that, Anders. And then we had one very specific question. I think this will go to you, Arcadio, if you're still on board. I know that we are a little bit over the schedule here. It is difficult in terms of the rates, or sorry, the tariffs on aluminium in euros as a theme. Is this related to specific HH codes, or is it only related to products that is containing steel, aluminium? Any measures in terms of information on the products, where it's being melted, that sort of stuff? Can you maybe concretely?
Yeah, that's a great question, and it goes back to the level of improvisation that I said that the US government is saying. Every day we get news, right, about this type of things, but we don't know. So actually now there has been released a list on the April 1st or April 2nd of the elements that they will be subject to the tariff, the new tariff. So then we will know more in detail. So I think that I searched around 40% of goods were kind of like subject to this tariff. But again, we need to review, because I think that they said 2 days ago that he wanted to put another aluminium tariff again. And then yesterday we came with the news that any country buying Venezuelan oil will also be subject to 25% tariff as well. So this is a little bit out of control, right? And I think that until we don't get the HS list, right, and specifically on that item, then we will not, because they're actually now the US are releasing some exception list as well, or part of that generic one.
Good stuff.
So for this case, I would also recommend maybe to use ChatGPT on taking on the regulation and said, okay, tell me which are the ones applicable or not. So then maybe you can avoid all reading the entire legal documents. Yeah.
Good stuff. Thank you, Arcadio.
Thank you.
All right. Well, you can follow us on LinkedIn, subscribe with DSV. We have a lot of good stuff coming out. We will continue with our webinars and market reports and news channels, etc. So don't miss out on that. And also, if you have any questions either on Xeneta related items, reach out to Patrick. Or if DSV related, you can reach out to me or your probably already identified contact points within the company. That's it for now, folks. I thank you very much for chiming in, and all of the great guest speakers chiming in as well. It was good to have this particular webinar, and we will do another one following up in Q2. Thank you very much, guys. See you soon. Bye bye.
Thank you. Bye.
Bye bye. Thank you.
Bye, everybody.